Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Wednesday, April 3rd, 2024. It's 10:42 a.m. Eastern Time, and I wanted to fire a quick one off to you, and I wanted to start right here. I'll get this chart out to you first and state that I think this is an objective short entry or add-on to the QQQ/NQ short trade. Remember, we shorted here at the top of the, this is the post FOMC rally. We're in at the highs. We're clearly in a downtrend. Active traders can trade as they want. There's plenty of levels. These are the levels I gave you in advance. And I wanted to just start out by saying we're at that 18,420 resistance level right now. That was one of the downside targets. It was the second target. It was hit here perfectly. We hit it again, tested, about several, these are 15-minute candles right here. So several 15-minute candles. The buyer stepped in again and again there. So what I want to point out is, this chart obviously goes to the left. There's some more reactions on it, but there was one there. This level was laid out back here when we put on the short trade. And so if I thought it was support there and I thought we'd get a reaction off it, if I didn't, I wouldn't have had the line there. It's even that much better level right now because we had we had that first reaction as an active trader. You could have booked profits and gained the bounce and got back short again. We bounced on it again and we bounced on it again. So 1, 2, 3 additional tags since I first put it there. It doesn't guarantee we're going to stop here, but what it does guarantee is that it helps to validate that as a important level. And remember, support, once broken, as it was right here, and you can see when it broke, we didn't just limp on down and kind of grind around. We shot straight down to these other targets down here. Support, once broken, becomes resistance. So that's it. No guarantees that we go down, but I can guarantee I believe that is an objective short entry, and I'm going to show you other reasons why as well. So that's the 15-minute chart of NQ for you QQQers. Let me queue up the 15-minute chart there. What we have is that downtrend line that we had off the highs. Remember the other day we had a false breakout right here, and I told you why that breakout was likely to fail. And also, the reason for, highlighting this as an objective short entry is because we're still in the orange zone. In fact, we got deeper into the orange zones today in both the 10-year Treasury and crude oil. And when that happens, it just kind of puts, and I know I get the vibe on the side. Most people don't short, and I've always known that. It's just something I'm a flexible trader, equally comfortable being long or short as I am long. But the simple part of it is we're in a very near-term downtrend. The intermediate term trend is sideways. That's this big box, this sideways range I've talked about. QQQ going nowhere now for well over a month and a half. And so that's the intermediate term range defined by the trading range. And then the near term range is very simple. We're making a series of lower lows and lower highs. That is the definition of a downtrend. So if you're trading that and you're, kind of what I call an active swing trader, or again, a regular swing trader that's shorted here and maybe you wanted to wait for a bounce back into resistance. Because remember, when you are a short seller or a swing trader shorting, you're a bull in reverse. You're buying, instead of buying the dips, you want to sell the rips. And you can randomly sell the rips just as you can randomly buy dips. But when I'm long and bullish, I like to buy dips, pullbacks to support. I call them strategic or tactical entries or add-ons. And so that's where we're at now. So, you don't see a horizontal line here like I had. And that's another reason I often repeat that even if I'm trading NQ only, I'm also watching the chart of QQQ or vice versa. If I were to be trading QQQ, I'd watch the chart of NQ because you don't see it as well defined here as the resistance level as that on NQ that I just showed you there, right there. Boom. So that's it. Take it, leave it, trade it, don't trade it. Or if you're bullish, you want to see a breakout. Next resistance, should we pop it, is 18,511. I would do the same thing, point out that that's an objective short if we happen to get there, especially if we remain in the orange zone right now on treasuries and or crude. And then finally, up to 18,600. I do not want to see a break above that, even though we'd still be profitable on the swing short. Something else, is going on. It would just possibly be another run to the top. Remember, the top of the range is up here, but this is good resistance. What I'm going to do, guys, right now, I'm going to pull the line up. That's where I initially had it. This is probably a better level, about 18,615. It comes in and it captures all these reaction highs right here. And so that really is kind of like for short sellers, the red zone, where I would not be shorting above that. Again, you maybe go to the top range and go down, just kind of hold off. And, if you're in this trade as a swing trade, well, you can have a stop at break even and nothing ventured, nothing gained, or you can lower stops to protect profits. Where to? Again, tactically speaking, or strategically, you'd want to have stops placed somewhat above each of those resistance levels, whichever ones you want, to allow for a brief, whipsaw. Sometimes you get that. Quite often you get that. They're called stop raids, very common in the markets. Alrighty, I want to show you. I gave you QQQ. So let's talk on the zones again and why I'm pointing this out. This is IEF. There's a 60-minute chart. So we're still holding. I'll rest easier on the swing shorts if and when these divergences get taken out, because the last time we had bullish, aka positive divergence on the 60-minute chart was right here. And we were in my yellow zone. We got a rally, and then it was a rally I predicted would probably fail because of the negative divergences, and we did. We went back in the zone, had another rally. Oh, that's the one I also predicted that would fail. Well, that one also hit resistance as well. But look, that's where we're at now, and we're still well into the orange zone. So again, my strategy now, my confidence, if it was high post-Fed when we shorted that, I can tell you it's a lot higher now, because now we're in that orange zone. We weren't in the orange zone before, after the FOMC meeting when we entered the short. So I'm just trying to reiterate why I'm in short the rips mode, and will continue. And then look, things change and this goes up for the right reasons, then I would either hold off on adding any new swing short positions, or be more concerned with stopping out. Where am I going to, cut the losses, or take not maybe, again, if from the recent short, that's not going to go to a loser, at least not for me. But I'm also on swing counts. I'm tell you, that's the last entry and that's the last trade. But there's also a longer term swing in play, which has 3 entry points really. The breakdown here, the primary trend line, the back test of it here. This is that trading range. So, average cost on that is about break even at this point, somewhere around there. Again, so I'm speaking to different time frames, different trades. I often talk about scaling into building position, and let's not forget, I have not wavered on the fact this is not an all-in moment and will not be unless 433 on QQQ goes. That's where I get personally aggressively short. So we're not there yet. All right, so let's go to the zones again. IEF still well in the yellow, orange zone right now. Positive divergence has potential to take us out of there, but so far kind of a muted response. I've got the after hours trades turned on, but let me just say this is the I'm going to get to that in a second with the stock market, the economic reports today. Let me just show you crude before we move on to that, because there's it's interesting what's going on right now, to say the least, in the stock market. And I've seen this movie before, but I'm going to get to that in 1 second, what I'm talking about. So orange zone, pushing the high end of the orange zone in crude, meaning crude prices just continue to go up, 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 up. That is inflationary. There's no two ways about it. That is the one thing, without even a close second, the only thing that we can track tick by tick. Remember, housing's a big component of the CPI, but you can't track that tick by tick. It's lag data, and so especially in regards to pricing, you can look at homes, homes for sale, listings, inventory, and all that other stuff, and closings. But at the end of the day, price is kind of, there's quite a bit of a lag there. But this by far has the biggest impact for anything that we can check tick by tick. And so we're very much still in the orange zone. And that plays into the GDX trade yesterday. I've made a follow-up comment that I wish and I would like it better, and I would have gone more aggressively, and I still might if it weren't for the euro US dollar pair, the 60-minute chart. I made a comment in there again yesterday under the comment section after I put that post, and I knew this ahead of time. I always check the euro. We were here. We had a bullish falling wedge 60-minute chart. We broke out, and it's going up. That is net bullish for gold and silver. However, gold and silver had a very unusual disconnect. They were going up recently, and it was because of the breakout. I mean, they went up because gold broke out to new all-time highs. It was a genuine 100% textbook breakout, and this is what I talk about. Every now and then there's these disconnects, so there is that kind of this is near-term bullish, and it is bullish because the euro and gold, do it yourself. Just take a chart of FXE, which is a euro ETN, and overlay it to gold here. You know what, I always say this, and then I'll just say I end up doing it. Sometimes it's easier. Give it a clean board. Here I'll go FXE. And then compare it to gold, edit chart properties, gold, and there it is. So make no mistake about it. The euro is really the opposite of the dollar because it's the largest component of the dollar index. And as you can see clearly, when they peak, they both go down. I'm sorry, gold is in yellow as it should be. FXE is in white. That's a weekly. I don't want a weekly. Let's go to a daily. Let's see it a little bit better. There it is. Okay, you can see the hyper tight, super tight correlation, unmistakable, especially since really this point. This is where inflation started to matter, right? Back in the beginning of 2022. So that's the point where you want to do these comparisons. And you can see here, unmistakable, super tight correlation, except recently. This is very unusual. And when you get that, you usually have a reversion to the mean. That means either euro's going to rally, gold's going to go down, or maybe a little of both. But gold kind of got ahead of itself based on the pricing. And the reason is when the euro's going up, the dollar's going down. It just takes more dollars to buy an ounce of gold. That's why it's not a magic formula about this correlation. So that is almost an immutable variable. Again, cost of gold, costs more to buy an ounce of gold when the dollar's weaker, going down, and vice versa, the other way around. But there is another variable in gold, and that is supply and demand. So if you have overwhelming demand, people buying gold, it can go up, but it's very unusual to see gold go up. And this disconnect is unusual. So So back to this. Either way, it was a 60-minute bullish falling wedge. A breakout measured target would take us up somewhere around. And you can see I have first resistance here, 108.334. I haven't updated this chart in a little bit, but downtrend line right there. So we'll watch this. And again, the case could be made, and I'm going to do that right now, just update that, based on gold, number one. So here's gold. Gold, there was the breakout, and this is why it didn't matter what the euro was doing, because it broke out to new all-time highs, and a lot of folks buying it. Breakouts to all-time highs are inherently bullish, because at that point, if a security goes to a new all-time high, nobody, I repeat, nobody at that point, I mean, just generally, if you froze, nobody sold that day. Everybody's positive. There's not a single person holding gold that's underwater just dying to get out, waiting to sell at the first pop. So that's what typically makes a breakout to new highs bullish. But after a while, the breakout's getting long in the tooth, you have this negative divergence. So that's one reason that I mentioned, or put the GDX short trade up. And when you look at GDX, there's another reason as well. It was based here on the 60-minute chart. There's our divergent high. It's up a little today, 1.3%. That's, I think, almost exclusively due to the rally in the euro, which I'm going to comment on in 1 second here. But you still have the nice negative divergence. We're still comfortably above our stop point. And so I still like but not love this trade. That's just the easiest way to say it. Plus, me throw out trade ideas, I diversify, spread it around. Gold, wheat, corn, natural gas, stocks, different sectors, bonds, whatever it is, and that's asset allocation and diversification. Okay, so the one thing I just wanted to wrap up on with GDX and gold, mainly GDX, is that GDX is a ETF that holds gold mining stocks, as most of you know. Gold mining stocks, as I often talk about, just like the airlines, Their biggest expense is labor, and their second biggest expense is fuel or energy costs to get the metal out of the ground. So we're seeing crude surging, and that is, gold miners. And you could say, hey, they've been lagging. There's a fundamental case, and blah blah blah. And yeah. That's we were long them right here at the lows. We milked most of that run up. So and then we hit that final target. And we had to pull back to the third target. And so I just wanted to say that net, this should be a headwind for the mining stocks, especially if it continues or doesn't abate. So we have, fuel prices or oil prices back to where they were back here, and not far from where they were back there. And you can see that was, what was that, back in June of 2022 when they peaked. And you can see the high prices, rising oil prices finally took their toll on the miners back then, and boom, knocked the snot out of them. So anyway, just wanted to point that out, that there's a fundamental component there, looking for that, as well as and on gold, look, and I answered that to, or replied to the comment section, yeah, longer term, this is nothing but bullish. I'm just looking right now. I think sooner than later we're going to have a pullback. At minimum, we're going to come check this uptrend line right there, and I think there's a decent chance gold can come and pull back, possibly all the way down here, and to any of these levels right there. So that's that. And again, it's a take it or leave it thing. If you don't agree, pass on it. I just wanted to share the logic behind, or the impact that crude may have, or ultimately will have on the miners. Okay, let's talk about one more thing, and then I'll keep the video quick, get it out to you. Let's talk about the economic calendar. Okay, so you can access on the site. You go to right side of the chart, right up here in the top. You click on resources, and then you'll get the tools of the trade. I check this all the time. You've got an earnings calendar, economic calendar, my position size calculator, everything you want. So you click on economic calendar, and that's going to take you to it. And so this is today here. And this is I've seen this movie before, but it's crystal clear what's happening. What I'm unsure of is how long it's going to happen for, and that is the good news is bad news thing, and bad news is good news, more so. If you Seinfeld buffs might remember the episode with Bizarro World, when there was Lane met a group of friends that looked just like Jerry and Kramer and George, quirky thing, and I think that was that Bizarro World episode, and where everything is like upside down and kind of backwards. And so we had two market moving reports today. You can see the orange dots right here. We had the ADP employment report. And so the consensus was for increase, a new, 150,000 new jobs, with a range going between 125 up to 175 jobs. Came in hotter than expected. That is good news for the economy, right? It's created more jobs, even well above the high end of the consensus range, blew away consensus. So stocks should rally, right? Because that's good for the economy. No, what it was bad for the stock market. Let me take it down to a quick 1 minute chart. All right, this is right here. I got to put you at 8:30. There's 8:30 right there, the line. Here's your time down here. These are the futures, NQ. So immediately on the good news, stocks shot down pretty hard. Why? Because, Powell's not going to give us our rate cut. The economy's strong, but we're not going to get a rate cut. Okay, so that's one thing. And then you had, after that, go back, we had the next one was ISM. That's ISM came in weaker than expected. The consensus was for 52.7. I believe anything under 50 is contraction, recessionary. And so the consensus range right there was 51.5 to 53.5. We came in well below consensus, even below the lower end of the range right there. And so that's saying that's bad for the economy, right? That's saying the economy is slowing down. But you can see that was at 10 p.m., right? 10 p.m. 10 p.m. is I'm moving my crosshairs to the 10 p.m. right here. We exploded higher. So again, the market is rallying on bad news. Guys, I can't make a promise to this, but I follow a lot of economic indicators. Remember, my background initially, business major, career stockbroker after that. Fundamental analysis was what I learned long before I learned technical analysis, and I incorporate both. And what I can tell you is the most accurate leading indicators that I follow all are singing the same song. Things are slowing down. What's really giving the bulls a strong case is the jobs market. But please look it up, read about the birth-death model that the government uses to calculate it and just how flawed it is. So this is setting us up, this dichotomy, if the market continues to rally based only on hopes of a rate cut, no matter, because it's just going to take the economy rolling over, the longer the economic indicators roll over, and the longer the economy shrugs off the bad news based on, okay, well, we're going to get, it doesn't matter, we're going to get a rate cut. That's dangerous, in my opinion. Okay, very dangerous. That there's going to be a point of reckoning where they realize, especially if they're, holding off on hopes of the rate cuts. By the time we're going to get rate cuts this year, that I promise you. Nobody's arguing that. But why is the Fed going to cut? Especially now with inflation roaring up, they're only going to cut because the proverbial shite is going to hit the fan at some point. Unless things change, and that's possible. We could start seeing some of the leading economic indicators, start turning up and stabilizing. It's certainly possible, but it's not the way it's looking now. And the point I'm trying to make is, the further this goes on, with the stock market rallying on bad news, and going down on good economic news, it's not normal, to say the least. And I just wanted to point that out. And you can continue to watch that trend. And again, all right, if I'm making your head spin, I've laid out a very, very simple and straightforward strategy, for the market. If you share my views, and even if you don't, you want to watch this. So as long as we're in the orange zone, even the yellow zone was where it said, yields are still high enough that it makes sense to, the case can be made to short or add to shorts if you're short now, if the technicals confirm them. Again, I started early in the video. If QQQ shoots above that resistance level that's a little bit below the recent highs, then then something else is going on. So, and with this, just keep in mind, with Treasury yields, that's the 10-year bond price right there. This is the yield of the 10-year. TNX is the yield of the 10-year. There's two components to this, and I haven't talked on this really much, if at all. There is of course, the absolute level, and that's why I have my zones. In the red zone, we hit the red. I'm sorry, yields going down. Yields going up. Yields going up. If we exit the orange zone, yields go much higher. We go into the red zone, and that's where the market will start to freak out, is what I said. And then, of course, this is what the market wants. And if it gets it, that should be, again, net bullish for the market, unless it's a flight to safety bid going down. But here's what I wanted to say. I don't know if you've heard about this. I forget what they call it. There's we'll call it the great debt roll. There's a massive amount of corporate debt coming due. We know that. We don't know the exact specifics, or I don't. Maybe it's out there. Please share it on the site if you come across the stats. I've seen it before, and I just don't have charts in front of me where a massive amount of debt, corporate debt, is coming due and will have to be rolled over. And so, and that starts this year and really increases into next year big time. That's all, debt that was taken out years ago in this ultra low, artificially low rate environment. And so, again, it's not a set line, it's more of a range, and it gets bigger and bigger. And so the way I'm incorporating yields and outlook, and I know the market's hyper focused on this too. You've got inflation and the hopes of rate cuts and all this. There are two components. The simple one is, like I've been showing you, the zones, right? We go up. I don't think anyone's going to disagree with me. That's going to be net bearish for the stock market. It's raising costs of capital to consumers, to corporations, to everybody. That would be bullish. But there's also this time element. Let's just say, for example, we stay in my orange zone. We don't go into the red zone, or we even drop a little, go to my yellow zone, but stay there. There's this time function. These are elevated rates. Right now, I know for a fact, this is not opinion, it's based on everything that's happened last year. The market's expectations when rates peaked here, that was, Fed's mission accomplished thing. The market thought we were going to be here right now. Almost all, if not all, of the rally so far from 2023 and early first quarter 2024 is predicated on these big rate cuts that are going to bring rates down. And so, and they're saying, okay, all right, well, they're still coming. It's just been delayed and it's going to do this. And that may be the case. Again, how much and the Fed's going to cut unless there's a financial problem, I don't think much. We'll see. Again, and this is a lot can happen. All I'm trying to say is the longer they stay up here, or the longer it takes for them to start cutting, the more and more companies are going to be facing, having to roll over. And some of them don't have the money to do so. As I mentioned, small cap stocks are the most rate sensitive. So far, today we've seen, as I showed you, the stock market's ripping on that, thinking because it probably just changed the trajectory of rate cuts. But look at IEF. IEF is still red on the day. And yet the stock market's turned green. QQQ and SPY and everything else is rallying like it's 1999. But IEF, the 10-year and TLT, the 30-year bond, they had a little lift on it, because the two, especially the ISM today increased, is a net increase to the case to cut rates by the Fed, certainly. But bonds certainly aren't reacting much that way, and the stock market's acting as if they are. So I just want to point that out. And they may, guys. Remember, I pointed out we've got the divergence there. I showed it to you on IEF. And I can make a pretty good case right now. You've got the positive divergence. Divergence is not a buy or sell signal. And then sometimes things that are in a downtrend, it's not uncommon to see divergences just get burned through. Right now, I know that I can tell you definitively, bonds, this is the 30-year bond, is in a downtrend. That means rates are going up. And unless this downtrend line, this is where things start to change on TLT. I'll make it bright and yellow and big. Anything there, up to there would just be a counter trend rally. If we get rejected, go on to make new lows. Remember, we were long treasuries here. We closed it out there, hit my final target. Then we turned around, shorted them somewhere in here, hit that first target. And if you're a long-term swing trader, you have these potential zones. These were, again, potential, or that last one was, but T2 zone we're getting closer to. All right, let me get the video out to you. That's it. Just wanted to share those thoughts. And, keep an eye on treasuries, keep an eye on crude, keep an eye on the euro, US dollar, or I'll do it for you. That's what you pay me for. All right, guys, this has been Randy Finney with Right Side of the Chart. Have a great day.